America's economy is standing at a peculiar crossroads. Despite steep tariffs imposed on nearly all trading partners, the expected economic collapse has yet to materialize. How can an economy so deeply intertwined with global trade resist such drastic shocks? At the same time, subtle signs of strain are beginning to surface. Prices are inching up, hiring is slowing, and growth is cooling. What lies beneath this fragile strength, and how long can it hold before cracks start to widen? The answers are more complex than they appear. The resilient economy puzzle. At first glance, it seems almost paradoxical that the U.S. economy has held together in the face of sweeping tariffs imposed on nearly every major trading partner. Economic theory often suggests that such broad and steep tariffs would slow growth, push inflation higher, and lead to job losses as costs rise and trade flows adjust. Yet, while some slowing has appeared, the feared collapse or sharp recession has not arrived. Growth slowed compared to previous years but remained positive, and consumer spending stayed unexpectedly robust. This resilience raises a fundamental question. Why hasn't the economy cracked under the weight of these trade barriers? The complexity of this situation goes beyond simple economic models. The economy's strength in some areas masks weaknesses in others, creating a murky overall picture. Inflation, while rising, has not yet spiraled out of control. Hiring has slowed, but so far has avoided a crash. These contradictions suggest that the impact of tariffs may be unfolding gradually, with delayed or uneven effects. Understanding this puzzle requires looking deeper at both the tariffs themselves and how different parts of the economy are responding. The full explanation is layered and multifaceted. It involves how tariffs affect prices, consumer behavior, corporate decisions, and government policy all at once. It is also tied to timing. Many effects expected by economists this summer may only be starting to emerge now or in the coming months. In this way, the economy's current stability might be a delicate balance, fragile yet resilient for the moment. The story behind this balance will become clearer as we examine the details of the tariffs and their consequences. Despite the surface calm, the economic tide is shifting. How this shift progresses depends largely on the specific tariffs put in place and how they ripple across industries and consumers alike. Tariff scope and scale. The tariffs introduced under President Trump's administration reached an unprecedented scale by August 7th, affecting virtually all U.S. trading partners. Some of the biggest economies faced relatively moderate tariffs around 15%, countries like the European Union, Japan, and South Korea. However, other nations including Canada, Switzerland, Brazil, and India saw rates soar as high as 35 to 50%. China stands apart in this scheme, with its tariff rate designed to climb even higher if no trade deal materializes, potentially reaching between 15 and 20% on average. To put these numbers in perspective, the average effective tariff rate at the start of the year was approximately 3%. The sudden leap to potentially above 10% means tariffs have increased more than threefold in a matter of months. This level of change is massive, effectively increasing the cost of imported goods across a wide range of sectors. Such a rapid escalation in trade barriers is uncommon, and it challenges established supply chains and pricing structures. Companies must decide whether to absorb these costs, raise prices, or alter sourcing strategies. Meanwhile, consumers may start seeing higher prices on everyday goods, especially in categories like appliances, furniture, and children's products. The scope and scale of these tariffs set the stage for inflationary pressures that could intensify if businesses pass along their increased costs. The immediate question is whether the initial tariff shock has fully registered in the economy's price levels and spending behavior, an issue that ties closely to inflation trends. Inflation's quiet stirring. While the most dramatic surges in inflation have yet to hit, there are clear signs that tariffs are beginning to push prices up quietly but steadily. The Consumer Price Index rose by 2.7% in June compared to the previous year, while the core inflation measure, which excludes volatile areas like food and energy, climbed about 2.9%. Both figures sit above the Federal Reserve's 2% target, signaling increased price pressures without an outright inflation spike. The impact has been especially visible in so-called big-ticket items. Appliances, furniture, tools, and children's products, the very categories most exposed to import costs, have seen noticeable price increases. June's price rises were actually sharper than earlier months, with many categories reaching record highs. These changes hint that tariff-related cost increases are starting to reach consumers, even if the full inflationary wave remains just beneath the surface. The Federal Reserve is closely watching these trends, intent on preventing a one-time price increase from morphing into persistent inflation. Despite the steady creep in prices, both the White House and the Fed have expressed confidence that inflation can be managed. Policy tools remain in place to prevent one-time tariff-related jumps from undermining long-term price stability. Yet, the longer tariffs remain in effect and businesses delay passing on costs, the stronger inflationary effects could become. With inflation beginning to stir, the economy's growth and consumer behavior provide another key window into its underlying health and future trajectory. Stay informed. Like and subscribe for more updates. Growth and consumer spending. Despite all the uncertainty, the U.S. economy showed some surprising momentum in the second quarter of 2025. Gross domestic product grew at a robust annual rate of 3%, an encouraging bounce back from a 0.5% contraction just months earlier. This turnaround was largely fueled by strong consumer spending, which continues to be the backbone of the American economy. That said, the overall pace of growth is slowing compared to previous years. When combining the first half of 2025, the economy expanded by about 1.2%, a marked drop from a 2.5% average growth rate seen in 2024. This deceleration may reflect businesses and consumers still adjusting to higher prices and uncertainty created by trade policies. Consumer spending plays a critical role in this picture because it directly affects business revenues and investment decisions. If spending weakens significantly, companies may postpone hiring or capital expenditures, deepening the slowdown. For now, though, spending appears durable, helping to cushion the impact of tariff-related price increases and supporting overall economic activity. Even as consumer wallets prop up growth, the labor market shows early signs of strain, hinting that the economy's momentum might face tougher challenges ahead. Labor market signals. The U.S. job market has long been a pillar of strength, but recent data reveal a clear slowdown in hiring that cannot be ignored. In July, job growth slowed dramatically to just 73,000 new jobs, well below the expectations of economists and market watchers. Moreover, revised figures for May and June cut the number of jobs added by a combined 258,000, painting a bleaker picture of recent labor market dynamics. This slowing trend places the Federal Reserve in a delicate position as it tries to balance two key goals: keeping inflation in check while supporting maximum employment. Raising interest rates too high could suppress inflation, but also risk causing unnecessary damage to jobs, while easing too soon might allow inflationary pressures to build. The Fed faces a two-sided risk where achieving both objectives simultaneously becomes a real challenge. Despite the slowdown in hiring, the labor market has not collapsed. Unemployment remains relatively stable, and many employers report difficulty finding qualified workers, indicating ongoing demand for labor. However, the clear cooling points to less momentum and heightened uncertainty about future hiring. Labor's softening underscores the complexities behind the economy's current state, especially as uncertainty deepens about what lies ahead when tariffs and inflation begin to reshape business and consumer choices. Future risks and uncertainties. As the year progresses into its second half, the U.S. economy faces growing uncertainty about how tariffs and other pressures will shape its future. Many economists expect growth to slow further, possibly drifting sideways with little or no expansion. This is not a classic recession, but rather a soft landing. Growth that remains above zero but below the trend experienced in recent years. What makes the outlook unpredictable is how businesses will respond once they fully assess tariff costs and make pricing decisions affecting consumers. This decision-making process by business owners could cause inflationary pressures to deepen or ease, depending on whether costs are absorbed or passed on. Clarity is expected to improve in the fall as companies gather data and adjust strategies, but until then, consumers may face a patchwork of price changes across sectors. Furthermore, the The Federal Reserve's balancing act continues, torn between curbing inflation and protecting the fragile labor market. How aggressively the Fed moves will influence borrowing, spending, and hiring, key factors determining whether growth can hold steady or falter. The U.S. economy's ability to withstand steep tariffs so far reflects a complex mix of factors, from consumer strength to cautious businesses and careful policy moves. While signs of strain are growing, a sharp downturn hasn't taken hold yet. Stay tuned as these dynamics unfold. If you found this breakdown helpful, please like the video and subscribe for more clear, insightful economic updates.